Hi, this is Mike Larson for Money and Markets TV. Just last week, I warned you that the momentum darlings of Wall Street, in particular Apple and Priceline.com, looked ridiculously overvalued and increasingly vulnerable. And just a couple of days later, they both tanked. Apple lost more than $65 a share, its biggest two-day decline in nearly 2 years, and Priceline tumbled almost $80 a share. I think this may be the beginning of the end of the out-of-control, easy money-fueled run there. But now, another sector is flashing bright red warning signals: housing. Earlier this week, one well-respected economist warned of, quote, ongoing challenges that are slowing the housing recovery, particularly tight credit conditions for builders and buyers, competition from foreclosures, and problems with obtaining accurate appraisals, end quote. So who did this bearish assessment come from? It was the chief economist of the National Association of Home Builders, David Crow. In other words, even the economist of the largest new housing industry trade group says the market remains relatively weak. Now, this is a change in tone from earlier statements from industry players. And given the most recent housing numbers, they simply can no longer be optimistic. For instance, the NAHB's Builder Confidence Index just dropped 3 points in April, missing forecasts by a mile. Moreover, the sub-index that measures current sales also fell 3 points, and the sub-index that measures buyer traffic slumped 4 points to its lowest level since December. As if that weren't enough, housing starts plunged 5.8% in March, following a 2.8% decline a month earlier. Now, they're at their lowest level since October. Now, it's true, conditions have improved marginally in recent months, driven mainly by some of the warmest winter weather on record. But because we had such an early start to the spring selling season, we're going to have an early end to it. Heck, the latest figures suggest it may already be petering out. Now, this could have a huge impact on the stock market because housing and related companies have been some of the strongest performers recently, along with those momentum darlings I mentioned earlier. Paint companies have been trading like dot-coms, while home improvement retailers have been acting like it's the middle of the housing bubble again. But I'll bet all those mutual fund managers who have dogpiled into these stocks are going to suffer a nasty fate. I wouldn't be surprised to see names like Home Depot, Lowe's, Lennar, and D.R. Horton suffer the same kinds of spills we're already seeing in stocks like Apple and Priceline.com. So please, if you own any of these stocks, get out of them before it's too late. And be on the lookout for any worsening of the economic data as spring progresses, and a potential slump in the broader market as a result. I'm Mike Larson for Money and Markets TV. Thanks for watching.